Welcome everyone. Happy Wednesday. Another edition of hashtag askrobco. The sun is out, the sky is blue. We started in a lockdown, and as of tonight or tomorrow morning at 12:01, we will be entering into lockdown 2.0 in the UK. And today we'll be discussing what the initial impact will be of that, how it will affect the property market, the industry, the wider economy, and how that impacts everything we're discussing at the moment. As you all know how everything works, you type in the questions on the right-hand side. James, who's with us today, welcome. And I will give you the answers, and we will touch on as many topical discussions, intel, data and trends that we can within the next 30 minutes. And we got so much to talk through because so much has happened within the last 7 days, believe it or not. We had a great session last week. For those who haven't seen it, with our friends from Lunres, definitely worth sharing and watching. That's on YouTube. Flick to that afterwards if you want to watch it. This week we've got our latest intel, which is very exciting to share. We've got the MRICS, the government guidelines on the property market, valuations as well. We've got UK house price index updates, mortgage approvals updates, and everything else we're seeing, and our views and opinions of what's going to happen in November, December, moving into 2021. So let's go straight in. We've got so much to get through. Get your questions through. Let's start with handout 2 and lockdown 2.0, and that's the guidelines from the MRICS and the government, which will come into play, as I said, of midnight tonight. And if you look at the handout section, that's handout number 2, and the main points should be here are: the housing market will remain open, and we'll discuss actually what that means for estate agents, surveyors, conveyancers, etc. People can still move house. That's really important. Renters and buyers will be able to do whatever they need to do to move, and that process will not be stopped. Valuations and home inspections. So that's us as professionals and as industry. We will be carrying on business as usual. So we will be doing inspections safely in accordance with protocol, government, COVID-19 requirements. Valuations and inspections will continue. And what I can share with you currently is the lenders that we work with, the institutions that we work with, the governance and the panel managers that we work with are all business as usual so far. We haven't heard anything to the contrary, apart from obviously safety first, health first, and protocol COVID-19 safe inspections, fully PPE'd and following guidance. Tradespeople can work in homes, gas, electric, etc. Builders, maintenance, construction sites should continue. The building industry will continue. So from that perspective, I don't know if you want to add anything, James. Property valuation, construction is going to be business as usual, caveat really strict COVID-19 safety first guidance following protocol. What's your view on that, James?
Well, no, thanks, Rob. From a surveying point of view, I'm out most days seeing properties, and thankfully the lockdown 2.0 doesn't have too great an impact. I'm still very cautious, wearing PPE, hand sanitizing, masks, face coverings, and from that perspective, it's very much business as usual. What will be interesting over the next month or so is some of the market activity and some of the purchases that we're seeing. I imagine a lot of those will be, the valuations will be deals which are currently agreed under offer and just moving through. So this month will maybe act as a, a time period for completion of those deals which are currently in the pipeline.
Okay, so let's go straight into the pipeline and the intel as a perfect segue into your viewpoint and your comment. So if we open up handout number 1 for those of you who are online and able to get this, hopefully most of you would have received it. And again, if you haven't, happy to send it over to you. So this is our weekly stats that we're following. And as I said, we started these stats during lockdown at the height of volatility and uncertainty, like really not seen before previously, possibly since Cold War, possibly Second World War, really unprecedented times. And here we are at week 32 post-lockdown. So we went into lockdown 32 weeks ago this week. And as of tomorrow, we're going into lockdown 2.0. And what is really incredible and amazing to see, really, is where the stats lie as of the week commencing November the 2nd. And you look at line week 43, where the date says 26th of October, and you see the sales column again over and above 500. That's new instructions. It's been consistent every week, 500 plus, 500 plus, 500 plus. The properties are coming on stream, a wonderfully consistent, robust market from that perspective. And then we move to the key indicator, the one that we're really following, the one that says actually what is happening on the ground every day and every week, which is where we're updating you. And that is the sold column, sold or exchanges that we work off. So we're live and we're not running 2-3 months behind like HMRC. We're live every deal that's exchanging. And the data and the figures that we've got for you today take us to the 234 number, which, if I'm not mistaken, correct me if I'm wrong, James, is our highest weekly figure of the entire year, if I'm not mistaken. Is that correct, James? Just to confirm.
Yeah.
And that is everything that I've been saying over the last few weeks about how this market is building and building. The pipeline is building and building. We're already 2 months over that pent-up demand, so forget that now. We're through that, and that was already done in August. This is the new market. This is the stamp duty, buoyed, cheap debt, incentivized marketplace. And as of this week, we have the highest figures. And when we look at the monthly figures, and I said to you last week, I said I really felt that we were going to get top numbers for the month, and the month has closed. And as you can see, in every sector, apart from the super prime 10 million plus, in the volume part, the 2 million, 3 million plus, we've got 125, 67 on the right hand side, which is the best performing month of the entire year for those transactions. That is telling you a tremendous robustness, tremendous sentiment, tremendous activity, and that now has happened for week after week, and there's sustainability and longevity. Now let's go back to the comment that James made. If the next 3 or 4 weeks is going to be challenged in terms of volume of activity because of lockdown 2.0, are we going to see those numbers drop? And the answer to that question is possibly. At the same time, the pipeline is so strong, there is no reason that for the next 2 or 3 weeks, all the deals will go through. And we might get to the end of November with still solid numbers, and it could tail off into December, which is notoriously a quiet month, as in the end of the month. So we might see just a natural decline of how the year would end out anyway. What are your thoughts on that, James?
Yeah, I think it's an interesting point. What's going to be slightly restricted in terms of any new sales, which are agreed, are the virtual tours of houses, if you like, which the sort of lion's share of the market is unfamiliar with. But in terms of prime central London, over the course of 2020, this is actually, we've seen a number of properties which have been agreed and sold with virtual tours. Move on to new builds, again, off-plan sales. Those, we wouldn't necessarily expect those to tail off significantly, because again, it's very much, you're not physically viewing a property or looking at sales brochures, floor plans. So it'll be interesting to see how the market adapts over the next month.
Definitely. I mean, so that everyone listening is aware, these numbers and the data and intel I'm going to share with you now from lenders and banks and institutions, they've done record volumes of transactions over the last quarter. They're maxed out in terms of product, which is why I said to you last week, some products are either being pulled or limited or capped to slow down the rate and volume of work, because the market and the industry and the supply chain can't cope with that. So what the next few weeks is going to do is allow a breather for that, allow conveyancers to catch up, they're behind, allow the valuers to catch up, they're behind, allow the mortgage teams within the lenders and the bank to catch up because they can't deal with the volume. And so actually we're on the back of record lending, record months, and we'll see that by going into handout number 4, which is the mortgage approval handout, which is what I said to you a week ago that I was really excited to see. And we definitely said that we believed it was going to be a record period. And as you can see by handout 4, UK approvals have reached the highest level since 2007, which is what I said a week or two ago. I'd be very surprised if that wasn't going to be the case. We're well into the mid-90s now of mortgage approvals. I stated that I believed it would get through 100,000. That's how buoyant I foresee in the market. Whether it gets through the 100,000 now because of what I've just mentioned with the banks and the lenders slowing down the rate, and also because of lockdown 2.0, time will tell. We got very close. I did say I believe we would get to 100,000 and break that barrier. At the moment, we're in the mid-90s, which is a phenomenal rate of applications, and it completely supports why banks and lenders and the marketplace are so buoyant. Record numbers, record volumes, purchases, sales, refinances, further advances. The market is at full capacity at the moment.
Yeah, it's been a positive 4 months in the property market since this reopened, and as we've seen with the October statistics, the momentum has been building over that 4 or 5 week period, which has again just reached the height of the year as we go into lockdown, and it could be an important stabilization period of the market. I know that Nationwide and Halifax have released some statistics in the last couple of days regarding some of the market growth, and this lockdown might just ease those sort of sales volumes, allow the market to catch up. The surveyors, the legals, we know searches have been very slow from the local authorities, from the land registry. It's held up a lot of sales, especially those in chains.
Yeah, I mean, let's look at that data. So that's, again, just been released in the last 7 days. Such strong information. That's handout number 3, UK house pricing, Halifax nationwide, 5.8% year-on-year increase nationwide. Halifax even higher at 7.3. And really that just reflects the the buoyancy and everything we're saying in terms of lending and borrowing and transaction and pricing and the sustainability of this and the legs that it has. Would it take us into September was the question. Would it take us into October was the question. Would it take us into November was the question. The answer to all of that is very clearly yes, yes, yes. Now the questions, and everyone rightfully should be asking, is does this go on till December? Does it go January? Does it go February? And then the question, and it's the big one that James wants to ask, and I'm going to ask for him, is what happens to stamp duty now? Does it get extended because of lockdown? And what happens if it doesn't? And where does the market go from here? That's the big question that everyone on the call wants to know. Lenders want to make decisions around the entire economy, and the property market is going to be affected directly by that. What are we thinking, James?
Well, it's an interesting one. We've had a lot of commentary the last few weeks around are people going to be able to have time to complete on their transactions to benefit from the stamp duty holiday, as the average period to complete on a purchase is around 4 months, with the holiday ending at the end of March. And will anything that gets agreed this month, December, possibly even January, will they be able to do a fast track completion? It'll be interesting to see. Will the government come under any pressure to increase it, to lapse that by a month?
So what are we thinking? Because of the current lockdown and the pipeline and the slowdown from suppliers, and then Christmas kicking in, are we thinking that the government may use that as an opportunity to extend the holiday by 3 months, by 6 months, the same way as they're doing with mortgage holidays, the same as they're doing with credit card payments, the same as they're doing to a degree with furlough? Do we think that the government will turn around and say 3-month extension, 6-month extension to allow for those transactions to go through?
It'd be an interesting one. I don't think there'll be an extension of that period, as any extension would obviously cost the government in terms of stamp duty, land tax receipts, in terms of the money in. And whilst mortgages, credit card payments there are holidays, there's still interest accruing during that period. So it's slightly different there. But they might offer something, the government, they might offer anything that's exchange contracts between, but before the deadline, might be able to still benefit from that stamp duty holiday, which might just sort of appease demand, because solicitors are going to be, I think, working through the night, burning the midnight oil over the coming months to complete all the transactions.
Definitely. I mean, it is the question that we all want answering. I believe there's going to be some kind of incentive, whether it's the 95%, which will be the equivalent of the MRICS back in the 80s, whether it's stamp duty, whatever the incentive is. I do believe, and I'll keep pushing this, that the government will use real estate, the property market, as its economic driver to get the country out of what will be and currently is a recession created on the back of COVID and the lockdowns that we're going in. Watch this space, and we will feed you all the information that we're seeing. For the last 10 minutes, thanks for your questions, keep them coming in. We're trying to touch on as many of them as we can. Let's go to the trends and what we're seeing, because as I mentioned, the lenders are sharing with us record lending, record volumes. Happy days for the lenders. Congratulations, well done, keep it going. From the surveyor's perspective, or the valuers, I've spoken to all the panel managers, they're doing record volume, okay? So they're doing well. The conveyancers are doing record volumes as well. So the supply chain, in terms of everyone in the distribution and supply within property and transactions, everyone is performing and outperforming and doing record numbers of transaction and volume, which is great for the economy and great for all the businesses involved. And anyone on this call will know how busy their teams are and their credits are and their sanctions are, and possibly risk already are flagging, okay, how are we managing this? Is this going to go out of control? Are we going to see a dip? And credit risk sanctions should all be aware of that. But let's go a bit deeper, James, into the trends and the highlights that we're now seeing playing out. And the two areas I want to focus on, and I know so many of you ask questions week in, week out: home counties, green areas, outdoor space, commuter belts, etc., etc. The growing trend from being in the heart of the heart and the heart of the center to a bit further around, and the high street, where it's being hit and penalized, and where actually there are some green shoots and some upturns. So let's start on the high street, James. Share with us the trends of that and where agility, innovation, and opportunity is rising.
Yeah, I mean, in the last couple of months, we've seen that small independent shops on the high street have been somewhat more adaptable than some of the main franchises, those blue chip companies. They're more adaptable. They've, as you've used the word, agile. They've been able to take advantage of sort of being fast to react, home deliveries, offers, and I think that's helped their survival. And ultimately, being those smaller independent companies, they've got lower overheads to cover and less sort of procedural sort of internal red tape, which they're having to get agreed before they can sort of sanction something to adopt it in their stores.
Yeah, I mean, in any business, in any shape or form, where you have flexibility and you're agile and you can move quickly to market changes and trends, that's the model that gives you the best opportunity to come through a challenging market like now, or take advantage of an opportunity. And what happens with chains is they're so big they can't always react, and they're not so flexible, and they're tied in to fixed contracts and trades and terms and so on that make their models very inflexible. The flexible models, the family businesses, the sole traders, this is their opportunity to take advantage of the new trends in terms of what people want from their village, from their high street, and the more local and localized independent outlet that's going to drive, it's going to get driven forward, because the trend for the next 3, 6, 12, 24 months is going to be that, and that's where you're going to see a lot of success. And when we move from commercial and retail to office space, working culture and trends, and what that means for commuter, outer London, greater London, home counties, I think we are starting to see extremely strong data and patterns that is telling us that the new demand and requirement is going to be larger space, and the range of commute could be anything from 30 to 90 minutes into London. And why is that? Because if you're only going to be required in 2021 and you're working for one of the major globals or organizations, and you're only required to go in 1 or 2 or even 3 days a week, then suddenly your commute isn't such a concern as if you have to go every single day and you want to be 20-30 minutes away. Now you can make the decision, I'm only required to physically be in central London for 1 or 2 days a week, which means I'm happy to commute 30, 40, 50, 60 minutes for that 1 or 2 days, because it doesn't bother me now, because I'm not doing it every day. And that is why the secondary prime locations in London or Greater London are outperforming. It's why the commuter belt is outperforming. It's why the home counties are outperforming. It's why the villages and the outdoor spaces are outperforming, because the new trend and guidelines that are going to be set by business is you're still going to have to come to the office when it's safe for us to reopen, but it's only going to be 1 or 2 days a week. And the mindset and the shift changes. If I only have to do that journey 1 or 2 days a week, I don't mind 40, 50, 60 minutes if I'm only doing it once or twice a week. When I was doing it every day, it became a drag. Now I can make my decision about my family home based on what I want, which is village, outdoor space, green areas, larger premises, and maybe a better environment to be in. James, wrap up maybe all of that.
Yeah, it's we've definitely seen an influx of former city workers, which are now relocating out of London or out of those city centre hubs, whereby they're able to say sell their house or where they're renting and sort of trade that in for, say, what would be on a localized level a couple of steps up the housing ladder for that sort of larger house, extra bedrooms, bigger garden, off-street parking, better sort of views, proximity to their local shops, amenities. So that's been the real draw for buyers over the last few months, and especially with the sort of potential of the next 12 months of that working from home, flexible working being the draw. They're going to have that sort of less pressure of commute times, whereby their sort of work-life balance, their quality of life, what they've able to enjoy outside of work has really really increased.
The trend in the next 12 to 24 months is going to be that one, and it's going to continue. And you're going to see buyer demand, which is going to put pressure on pricing, and it's going to allow those markets to remain robust and in demand. And the inverse will be certain markets won't be so robust and won't be so in demand. And that's all okay, because all markets work on demand and supply, and all trends and patterns change cyclically, per decade, per generation. And now we're seeing another shift change, and you're going to see the pockets of the parks and the villages in London are going to really perform well, where you get better value for money, larger space, and you can walk, and you've got your independent trader, like we've just said. That's going to be the makeup of people's lives for 12 to 24 months, and that will set the path for the short and medium term future of the industry and where pricing changes. And I think that's just fascinating, where the industry is, where the markets are, where pricing is, where product is, where the market is in general, both commercially and residentially speaking, where we go with stamp duty, where we go with the government's incentives to fuel the economy with the housing market, and going into lockdown 2.0, which looks like being a lockdown light in terms of the property sector. And we're going to have to see in the next few weeks how it affects transactions and trades. I believe we'll get through November with good volume, and it might drop off, should I say, in December as we close out the year. Final comments for today, James?
Final comments. I just wanted to bring those lenders some news which may offer some development finance to as a sort of mortgage product. We obviously a couple of days ago saw on Durham Place, which is a very prime street in Chelsea, which fronts the green space of Burton Court, the shocking images which came out of the house collapsing with those neighbouring properties getting evacuated during the night. It just it sort of brings alarm bells for those lenders which have those heavy refurb development finance projects and products which they offer, the importance of some of their sort of project monitoring surveyors, and what safety, what monitoring provisions that they have in place to ensure that these developments, which are at the higher risk scale, run smoothly, and what provisions are in place to try and mitigate against these types of construction accidents.
Yeah, great point, James. I mean, there's one of those cases every year. Everyone on risk and credit and sanction. I know how you feel. First thing you want to do is check your books. I pray it's not one of ours, and I'm sure everyone did that. But you do get one of those cases every year, and generally it's always the basement dig and the house coming under. So great point. Everyone, thank you all for your emails and your direct messages to me. Thank you for your amazing support, your amazing questions. We're loving giving you the updates. We're not loving going into to lockdown 2.0. We're not loving having run the entire show from lockdown 1 to now lockdown 2. The great thing is we're hopefully providing with great content, great intel, live information for you to do your credit, do your sales, do your product, do your pricing, or just have an update on what's going on and you can share with your colleagues. And hopefully we're here to help support you and guide you through tremendous volatility, tremendous uncertainty, and give you some added value. So thank you so much for your support. It's been incredible. I really appreciate it. Super grateful. And we will see you same time same time, same place next week. #AskRobCo. Follow all the platforms: LinkedIn, YouTube, Instagram, Twitter. Keep asking your questions. Anything we're not producing for you or providing, tell me, message me, and we will get it for you, I can assure you. Be safe, be healthy, stay at home if you have to, and we'll see you all next week. Thanks, James.
Thanks very much, everyone.